Welcome back to the channel, everyone. Today I want to talk about how Elon Musk just exposed SEC corruption and could be causing a Twitter short squeeze, which would obviously expose the shorts. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Whole Catalog tweeted saying the texts between the Saudi PIF and Elon Musk confirmed they were serious about taking Tesla private. There must have been some leaked texts between the Saudi PIF, which is the Public Investment Fund of Saudi Arabia, and Elon Musk offering him the funding to take Tesla private. And he said, notice they asked for a Saudi factory, as in a Tesla factory in Saudi Arabia. He said this was also the term of their deal to take Lucid private, or the terms of the deal where Saudi Arabia invested $2 billion in Lucid Motors before it merged with CCIV and became listed as LCID. He said the fact they did the deal, just not with Tesla, because obviously they did the deal with Lucid pre-listing, shows that the Saudi PIF was absolutely serious. Elon Musk replied saying the head of the Saudi PIF committed unequivocally to take Tesla private with me, as witnessed by the Tesla CFO and several others. He said that's why I said that funding was secured. This is obviously in relation to Elon's tweet from last year where he said that funding was secured and that he was taking Tesla private. The exact same tweet that he was actually sued for by the SEC for manipulating the Tesla stock price. Also, the exact same tweet that he was actually forced to settle with the SEC and admit defeat, otherwise banks would have withdrawn funding from Tesla and bankrupt the company. Elon was obviously unhappy that he had to unlawfully submit to the SEC and admit wrongdoing, even though he was technically just tweeting a factual statement. Pranay also replied saying Tesla at the time, back in 2018, wasn't in a good financial situation, and the SEC knew that funding was secured, but still decided to go ahead with the investigation. And again, Elon replied saying the San Francisco office of the SEC were shameless puppets of Wall Street short seller sharks, while doing nothing to protect actual shareholders. He said, this is why I lost all respect for the SEC. And therefore, Elon Musk is exposing firsthand that the SEC basically works for these short-selling sharks. The SEC is obviously in bed with the short sellers, and this is something that's not just speculated amongst AMC apes, it's actually being spoken about by Elon Musk himself. And Unusual Wells has tweeted that Twitter has actually agreed and accepted the Elon Musk deal. Unusual Wells tweeted saying Twitter stockholders will receive $54.20 per share. He said upon completion of the transaction, Twitter will become a privately held company entirely by Elon Musk. Elon Musk isn't just buying the company and leaving the company as a publicly listed company listed on the stock exchange, he's actually going to delist the company and take it private. And Hang Loose has realised what this actually means and has put together all of the pieces of the puzzle. He said, now here's the big Twitter scenario. Those who currently are shorting the stock, aka shorting the Twitter stock, will need to return their borrowed shares to the lender so that the lender may receive the $54.20 per share. Obviously, all of the shares currently lent out have to be recalled, and all of the shares currently being shorted have to be covered so that Elon Musk can purchase all of the rightful true shares and take the company private. Those currently shorting the stock obviously have to cover their short positions and return those borrowed shares back to the original owner so that Elon Musk can purchase those shares. And Hang Loose said, meaning that shorts have to buy back shares on the open market to obviously return to the lenders. Now you may say, Tom, what happens in the case of synthetic shorts? Obviously the shorts shorting legit shares that have located a share to borrow obviously need to cover their short position and return that borrowed share. But if there's synthetic shorts, they obviously never located the share in the first place, therefore never borrowed it, and therefore don't really need to return it. Do they have to cover their short position and delete the share that they've created, or can they simply hold the open synthetic short position? But I guess there's also a part 2 to this question as well, which is there a large synthetic short position on Twitter? Obviously we know there's a massive AMC and GameStop synthetic short position, but is there really that many naked Twitter shorts? Guys, if you didn't already know, Moomoo have just increased their offering of free shares to 6 free shares valued up to $3,500 each. So that's a total of up to $21,000 in free stocks, just for signing up with Moomoo using the link in the description below and making your first deposit. Moomoo and Futu have also officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Moomoo also recently won the award for being the best trading platform at the FinTech Breakthrough Awards. Moomoo is very easy to use, it's incredibly customizable, and it will help you to trade like a pro. Moomoo also has tons of technical indicators and advanced charting tools. Moomoo publishes daily short selling data, position cost distribution, and much more. So guys, be sure to sign up to Moomoo using the link in the description below to get up to $21,000 in free stocks. I don't really think the synthetic short position on Twitter will be that large. Is there a current hate campaign and a current attempted seller boxing of the Twitter stock like there is with AMC and GameStop? Not really. Is there a massive retail investor holding of the Twitter shares? Are 80% of the Twitter shares held by retail investors like AMC and GameStop? And the answer to that is also not really. Twitter is largely being held by institutions. And therefore the signs don't really point to there being tons and tons of synthetic Twitter shorts. However, it does still mean that all of their short positions have to be bought back and closed out and returning those shares that were once borrowed. And as Hang Lu says, this will cause a squeeze as long as the integrity of market structure isn't fraudulently manipulated. He said, let's see what type of crime they'll attempt for this situation. Now, as I said, I don't believe the synthetic short position is too large for Twitter as a company, and therefore, even though there will be a short squeeze, as shorts will panic to close out of their positions, it won't be as dramatic as an AMC or GameStop short squeeze. However, Further did reply saying that was my first thought when Musk announced he wanted to buy. He said, I wonder how many synthetics there really are. Hang Loose does give a very valid reply by saying with the way rehypothecation is uncapped via proxy in Euro markets, I bet there's an absolute ton of synthetic shorts. He said it is a 100% fact that people and institutions are currently shorting Twitter. He said if we don't see this stock squeeze at some point, then something massively corrupt took place and people need the answers. While I do think there are institutions and people shorting Twitter, there isn't the same hate campaign and seller boxing strategy being employed against the Twitter company and against the Twitter stock as there is with AMC and GameStop. We don't see hundreds upon hundreds upon hundreds of motley fool articles telling retail investors to sell their Twitter shares and invest in other social media platforms like MySpace or Bebo, for example. Obviously, most major news outlets stay away from talking about Twitter and definitely don't spread hate about the Twitter stock because obviously Twitter is mostly held by these large hedge funds. And therefore, even though there is the ability to rehypothecate shares or rehypothecate shorts an unlimited number of times, just like there is with AMC as well, there isn't quite that same Twitter hate campaign. But obviously, I guess the real way to tell is just by watching the Twitter stock over the next few days and seeing just how dramatic the Twitter short squeeze ends up becoming. Again, if Twitter does squeeze and there is a large squeeze, this is only going to be more and more beneficial to AMC and GameStop holders because these shorts are going to be losing more and more money. Obviously, if Twitter squeezes, then these shorts are going to be massively underwater and they will lose massive amounts of their available margin and be closer to that dreaded margin call, which would cause the AMC and GameStop squeeze. And as Hang Loose said, he's just realised that the institutions shorting GameStop and AMC over the last 4 years had entered positions no higher than $15 per share. And he said that means that they're currently underwater by at least 1,000% in the red and they're still holding to their original short positions. And he said since when is that smart money? Because they're literally trapped. Now obviously many of these hedge funds have been averaging down their short positions and using the available margin in their accounts to so far avoid a margin call. But as their available margin continues to shrink, they just get closer and closer to that dreaded margin call. And I think Foray has really hit the nail on the head here with Melvin Capital in a nutshell. I think you can really just imagine Gabe Plotkin talking to his investors and saying, step number 1, I short the company and lose money. Step number 2, I double down on my shorting. And step number 3, I bankrupt my company. Hang on, I bankrupt my company? I think Gabe Plotkin is really starting to realise just how much of a mistake he really made by shorting GameStop and AMC. And I also wanted to quickly touch on and recap my video from yesterday where I spoke about Amazon moving on away from AMC and GameStop to now short Netflix instead. Only a few hours later, MarketWatch posted the article saying after Netflix and CNN Plus busts, Wall Street wonders if streaming is really a good investment after all. It seems that not only Jeff Bezos and Amazon, but also the whole of Wall Street is moving away from streaming platforms like Netflix and is actually starting to short streaming platforms. Maybe Wall Street will move back towards brick and mortar cinemas like AMC and will take out long positions on AMC and cover their shorts. The article says that no streaming service appears to have the customer to themselves. After years of massive growth, new Netflix competitors have given consumers great choice and made investors wonder if there will be a big winner. It says Netflix's second consecutive ruinous quarterly forecast pummeled the stock this week. $50 billion in market capitalization, which is 5 times the size of AMC, aka $100 AMC, disappeared in one day alone, and also made Wall Street wonder if streaming services are a good investment in general. And it says, we believe investors are now questioning the long-term market potential in streaming, Bank of America global research analyst said in a note on Wednesday. And funnily enough, even Rich Greenfield of Lightshed Partners weighed in and said that it's becoming clear that the profitability of subscription video on demand, aka Netflix, may not be nearly as compelling as investors hoped and certainly nowhere near as profitable as the legacy businesses that streaming is replacing. So right there we're seeing Rich Greenfield of Lightshed Partners actually praising brick and mortar cinemas like AMC Entertainment. It seems that even Rich Greenfield is moving sides away from shorting AMC to now shorting Netflix instead and saying that AMC is a good investment. And to back that up, if we look at the quarter to date box office earnings for quarter 2 of 2022, they are absolutely ridiculous. So far, for the first month of quarter 2, we've generated $492 million in the box office, which when compared to 2019, 2018 and 2017 is right up there. And I think the most impressive thing is looking at the averages. Back in 2019, 2018 and 2017, we were averaging around $3 million per box office showing, with over 200 showings in the first month alone. Whereas in 2022, we're averaging a whopping $6.5 million per showing. And also, if we look at the number 1 grossing film, we can see that in some years, like in 2015, there was one singular film responsible for over half of the quarterly earnings. Whereas right now, the biggest film so far is not responsible for half of the quarterly earnings, it's responsible for much less because the film wasn't overly as good compared to some other films, but it's because our average is so high. I would like to see over the next 2 months as we complete the full quarter 2, exactly how much revenue is generated in 2022 compared to 2019 and before. I think if we have some brilliant releases, which we are scheduled to have in quarter 2 of 2022, we could even beat previous years like 2019, 2018, 2017 and before. Guys, be sure to let me know down in the comments below what you think about Elon Musk exposing SEC corruption and potentially causing a Twitter short squeeze. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.